The GDP is projected to stabilize at 4% in 2025, which is equal to the same GDP growth rate last year. And next year in 2026, growth would recover with expectations of continued improvement at 4.3%, reflecting the region's economic resilience. As a committee, we also looked at global inflation trends. Global inflation is overall easing, with a projection of an inflation rate at 4.2% compared to 5.6% that we had in 2024. In sub-Saharan Africa, it's the same trend. When we had last year an inflation rate at 18.3%, the inflation it projects you to decrease at 13.3% in 2025. It's still high, and risks such as currency depreciation and food price volatility persist in some economies in our region. We looked at commodity prices, which are projected to decline. As you can see, be it on the energy index or non-energy index, they're all falling, with energy prices expected to fall by 17.4% this year, following OPEC's decisions to increase supply. Food prices are also expected to reduce by 7%, which will ease import cost pressures. However, we see that prices of export commodities such as coffee and minerals remain elevated, but this supports Rwanda's exports earnings, since these are traditional exports that we have. On the external sector, the data on Rwanda's international trade is encouraging. In the second quarter of 2025, exports increased by 15.5%. And this was driven by strong performance in traditional exports, especially coffee, with favorable global prices, but also higher volumes. When we also looked at non-traditional exports, they were rising by 31%, and these are mainly products of cooking oil and wheat flour, reflecting the good performance of our domestic industry sector. On the other hand, we saw that imports grew only by 3.3% in the second quarter of 2025, reflecting a moderate increase in the imports of intermediate goods and notable declines in fuel and capital goods imports, while increases in consumer goods were driven by domestic demand. Therefore, the trade deficit in the second quarter of this year narrowed by 2.9%, which is a positive development for external sector stability. This has an impact on our foreign exchange market, where foreign exchange pressures reduced when we compare the second quarter of 2025 and the same period in 2024. At the end of June 2025, the depreciation of the Rwandan franc against the US dollars was at 2.96%, whereas a year prior it was at 3.73%. And this improvement in exchange rate stability can be explained by a narrowing trade deficit, as we have just seen, a weaker US dollar on global markets, but also the impact of domestic foreign exchange market reforms that we have conducted. We are now moving to the domestic economy performance. Rwanda's economy continues to perform well in the second quarter of 2025. As you may recall, in the first quarter of this year, GDP growth stood at 7.8%, with broad-based contribution from services and industry, and a modest recovery in agriculture. Data for the second quarter are not yet released, but when we look at our high-frequency indicators, they point to a sustained economic momentum in the second quarter, with our composite index of economic activities rising by 12.5% in the second quarter, reflecting strong performance across all sectors. We now move on to the monetary market developments. In the second quarter of this year, all rates have declined. Starting with money market rates, the interbank rate on average in the second quarter was at 6.3% compared to 8.14% that we had in the same period in 2024. In line with the CBR, the deposit rate also has reduced to 9.75%. This is in comparison to 10.17% deposit rate we had in the same quarter, in the same period in 2024. And in the lending rate on average, they also decreased at 15.97%, which is a decrease from the 16.25% that we had in 2024 in the second quarter. As a committee, we looked at inflation developments domestically. For the second quarter, headline inflation has stabilized at 6.7%. This was driven mainly by a decline in core inflation that has offset an increase we've seen in fresh food, but also an uptick in energy deflation. The decline that we noted in core inflation reflects lower transport inflation, with the fading impact of upward revision of transport services a year ago, and this offset increases in core hotels and food inflation. For fresh food inflation, the increase is driven by higher vegetables inflation, reflecting the end of season A, but also the delayed season B harvests. When we take a look back at inflation trends since 2022, you may recall that we had very high inflation in 2022 and 2023, and a core inflation, which excludes volatile elements of the consumer price index, it's the yellow bar on the chart, consistently reduced from the first quarter of 2024, and we had a peak in November 2022. Thanks to the monetary policy stance and other policy measures to maintain price stability, headline inflation has remained within the range since the first quarter of 2024, although we have started to see pressures in the last quarters that have driven headline inflation to 6.7%. In recent months, we're also seeing inflation pressures. In July, headline inflation stood at 7.3% from 7% in the previous month, on the back of an increase in core and energy inflation, while fresh food inflation declined. And so as a committee, we look at projections for inflation. Although inflation is expected to remain within the target range that we have of 2% to 8%, we see that headline inflation is projected to average 7.1% for this year, reducing back to 5.6% in 2026. The upward revision of these projections compared to the last round of Monetary Policy Committee in May is due to several factors. And in addition, we see that there are risks to this outlook, particularly linked to adverse weather conditions, which could affect agricultural production, geopolitical tensions and trade uncertainties that could influence domestic conditions, as well as the fact that we have uncertainties on agricultural productions. And as Monetary Policy Committee, we continue to monitor these developments. And therefore, taking into consideration recent developments as well as new projections, the monetary policy has decided to increase the central bank rate to 6.75%. This is a slight increase of 25 basis points, and this level for us is considered adequate to keep inflation within the target. And that's the end of our first presentation on monetary policy. I will now move to the Financial Sector Committee discussions and decisions. The committee reviewed recent developments in Rwanda's financial system and assessed potential risks to stability. The financial sector continues to expand, driven by strong economic momentum. As of June 2025, as you can see, total financial sector assets grew by 23%, reaching 14 trillion. And growth was recorded across all sectors. Banks' assets increased by 23%. On the microfinance side, the increase was at 21%, while the pension sector assets also increased at 26%. On the back of rise in contribution following recent changes in public pension contribution rates. Insurance sector's assets also rose by 18%, and this growth reflects overall a stable and deepening financial system. As a committee, we also looked at the role of the financial sector in the economy, where we can observe continued financial deepening to support economic development. Assets to GDP ratio rose to 71.3% in the second quarter of 2025, up from 65.6% that we had a year earlier. And this performance is linked to strong growth in deposits, higher returned earnings, and sustained credit expansion. I will talk about credit developments. The financial sector continued to play a key role in supporting economic activities, with outstanding loans in banks increasing by 15% and loans in microfinance institutions growing by 20.8%. And when we look at active borrowers, being households and corporates, they are now reaching more than 1,100,000. We also look at now, go back to banking sector stability. So the banking sector remains sound and stable. Its capital ratio is adequate to absorb shocks, with the capital adequacy ratio at 21.6%, well above the minimum requirement of 15%. Non-performing loans have also dropped 2.6% in the second quarter of 2025, which is well below the maximum threshold of 5%. And the liquidity coverage ratio is at 289%, well above the minimum of 100%, reflecting ample liquidity in the banking sector. Moreover, when we look at profitability for the sector, it remains high, with return, going back to the banking, return on equity is at 18.6% for the second quarter, and the slight decline observed compared to the same period last year is due to slower growth in interest income and rising operating costs. The microfinance sector remains healthy and efficient, with notable improvements across key indicators. The capital adequacy ratio rose to 34.7%, supported by capital injections and the conversion of borrowings into equity. Non-performing loan ratio declined to 3.4%, and while in profitability improved, with return on equity at 14.8%, driven by aggregated better loan quality and strong credit demand in the sector. I think we might go back to the financing of sectors that I skipped. As we were looking at the credit markets, we observed that finance sectors by banks were first and foremost construction, then the trade sector, manufacturing, individual loans, and then transport. For the microfinance sector, it's another picture where the trade sector is the first financed during the quarter, followed by construction, agriculture at 14%, and education at 10%. We thought it was important to also show by sector how credit is being dispersed. As a committee, we also looked at the progress in consolidation of Murenge SACCOs. There is good progress where now we have 9 district SACCOs that have been formed, and 5 additional district SACCOs are in the final stages of the process. And this consolidation has led to expanded lending capacity that we've just seen in the numbers for the microfinance institution, improved service delivery, and greater operational efficiency of Umurenge SACCOs and now district SACCOs overall. We move now to the insurance sector. The insurance sector was also meeting all prudential requirements, being in terms of solvency ratio, which is now at 215%, above the minimum threshold of 100%. The liquidity ratio was also 109%, above the minimum requirement, which allows the insurance sector to meet their short-term obligations. And profitability remains solid, with a return on equity at 19.2% and return on assets at 8.6%, driven by investment income, although we noted as a committee that there are still challenges linked to underwriting performance. Moving on to the pension sector. The public pension fund assets continue to grow with a growth of 26%. To 2 trillion Rwandan franc by the end of the second quarter 2025. But at the same time, the benefits for pensioners have also increased by 61%, reaching 43 billion in the first 6 months of 2025, which enhances pensioner welfare. The committee looked at developments in Ejoheza long-term savings scheme, which also expanded significantly by 31%, which is total assets now at 80 billion. And also looking at contributors, they continue to increase, but mainly at 82% of all Ejoheza contributors are in the informal sector, which gives confidence on the purpose of Ejoheza to provide pension and insurance coverage for people in the informal sector, demonstrating the scheme's growing reach and also inclusivity. And lastly, as a committee, we looked at retail digital payments, which continue to drive accessibility and efficiency, highlighting increased usage across various platforms. As you can see, retail payment as of June 2025, they had reached 68 trillion Rwandan franc, and now electronic payments account for over 343% of GDP, underscoring the growing role of digital finance in supporting inclusive economic activity and financial sector transformation. We also looked at eCash, which is Rwanda's interoperable instant payment system, continues to support the national vision of a cashless and inclusive financial system. As you can see, adoption is also increasing, with transaction values having increased to 37.7 billion at the end of June 2025, which is a fourfold increase from the 9.4 billion that we had in the same period in 2024. In terms of active users, eCash now has 2.1 million users and has already onboarded 20 financial institutions as participants. This reflects increased trust and usage across the financial system. Now, what we looked at as a committee is potential risk. We expect our financial sector in the medium term to remain stable and resilient. However, some risks that we have identified include potential rise in cost of funds in global and domestic markets, potential decline in asset values, particularly equity prices, amid ongoing financial uncertainties globally, as well as operating risk stemming from the increased use of digital financial services. Another risk is around credit and deposit concentration, particularly in the banking system. In response, the National Bank of Rwanda remains vigilant and committed to implementing timely evidence-based policies to preserve the stability and soundness of the financial system.